Brandon, I want to talk about mindset first. I do the GoBundance mindset calls with Jason.
Mm.
And I know obviously that he is your mindset coach. And one of the things he said recently, he said that when he gets his clients, one of the first things he does is rip off their rear view mirrors. And when he does that, their life explodes.
Mm.
So my question was, did he do that for you? Do you remember a season, a call, a week where he said, Brandon, quit looking in the past, quit living out of your past. Let's look to the future and do something different. And then all of a sudden you start scaling, or you find clarity, or you find peace. Did that happen for you?
Yeah, in a way, yes. When I started talking to Jason, I was very much, what's the word, comfortable. I was at a very spot in my life where I was very like I had a lot of money coming in from book royalties. I was selling a lot of books. I was doing the Bigger Pockets podcast. I had a bunch of real estate. I had cash flow coming in, and everything was just like pretty, like just straight. So in that way of the rear view mirror idea was more like I was living in my past. Like I was resting on my laurels, maybe to use that cliche.
Yes.
I was like, and I was fine. Like I was, whatever. I don't have to work hard. Like it was very easy. So what he really challenged me on was like, well, what do you want? Like, what sounds cool? Like, I'm like, well, everything's going on. He's like, stop looking at that. Like, that's great. That's your past. I never thought about it in those terms. If that's what he was doing, that's exactly what he was doing. It's like, what do you want in the future? Like, what's out there? And he really encouraged me, to think differently, to think like, if you could do anything, he says all the time, if you could do anything and not fail, if you knew that failure was impossible, like, what would you do? What would you go and tackle? And that's like what led me into eventually building Open Door Capital and the big funds and everything I've done, even leaving Bigger Pockets podcast. All that was stemmed from that. What sounds amazing in the future?
I love that, man. I love it. It's amazing what happens whenever you stop and think about what could be. And I love those questions that he asks us in that group.
Yeah.
Do you have any other coaches? Do you just coach with him? Do you have like a health and fitness coach? Do you have a business coach, finance coach? Tell me about just coaching in general.
Good questions. I have, so not really. I actually probably should do more of that. I have I'll call him a therapist, even though technically he's a performance coach and I'm not technically in therapy, but he is a licensed therapist. They're just not licensed in the state, but he also does performance coaching. I've been talking to that guy lately. And he goes a little bit, and I did that because I was like, well, I love performance coaching. What if I talk to somebody as well who's like trained, like clinically trained to be able to like dig into your past? And I thought, what could I find there? So I've been enjoying that a little bit, a couple months into that. That's been interesting. We don't talk business whatsoever. It's all just really deep personal stuff in my past. So that's been good. I've got a fitness. There's a company out there called My Body Tutor, and I've known about them for years. I've had a couple of friends who lost a ton of weight with them years ago. And what My Body Tutor does is it connects you with like an actual like one-on-one coach essentially for food. And I record every single meal that I eat in their app. It's My Body Tutor's app. I record every food I eat. And then the next morning I wake up and there's feedback from yesterday's meal.
That's
so the guy will be like, hey, like I really like that you kept it light at breakfast, cool that, lunch was, tacos, but did you really need the double serving of rice? Could you have maybe, got cauliflower? Like just questions, right? And just real-time feedback or, 24-hour later feedback every single day. And it's like, it's under $500 a month. It's not a crazy amount of money, but man, when I first did that, like 5 years ago, I started working with them. I lost like 40 pounds, like right away. Dang. It was amazing. Now, over the years, like I gained some of that back and some of that's muscle. I got more into jujitsu and stuff. So I've gained some of it back. But recently I started feeling it again. I actually stopped working with them after a while. Like we stopped working so regularly with them because I was like, oh, I got this.
Yep.
And so I eased off and then I gained back like 10 more pounds than I wanted to. So now I got back on with them. I'm recording my food again. And guess what? Once again, I'm losing the weight.
I love it.
Because like, I respond so well to accountability. Like I don't, maybe not everyone's like that, but if I know somebody's going to be disappointed in me, like, or is going to call me out on something, I will do it. So that My Body Tutor has been hugely influential in my life for that reason.
That's awesome. I'm going to have to check that out. So Brandon, transitioning to coaches or consultants, economists, whatever, obviously this is October, 2022. We are in for, a market shift, a correction, all the words that describe what next year might look like. Who are you getting your information from? What's the sources that you go to so that you are informed on whether you're going to still buy, you're going to hold, you're going to sell, all those kind of things? Where do we need to look for that kind of information?
couple things come to mind. First of all, I'm a big believer that nobody knows ever, right? Like some of the smartest, and like people like that I follow online that I'm like, oh, these people, when I think of like, they understand the economy and markets and stuff, like I followed them for a decade or longer. They're always wrong all the time, right? Like they've been wrong more than they've been right. It's like the analogy, like or the story back in the day of like they took a bunch of monkeys and gave them like darts, and they had to like throw like darts at a stock picking board, and they picked better stocks than the professional stockbrokers.
That's
so
right.
At the end of the day, right? Like nobody knows this stuff, right? Now there are sources of data that I look at. Actually, my favorite thing is actually my buddy, he runs like the Data Deli. It's called the Data Deli. It's David from Bigger Pockets, so not David Green, but other Dave Meyer. I love what he does with his research and stuff. He keeps it very like whatever, like cookies on the lower shelf. So like I can actually understand, because I don't understand. They're like, oh, the CPI of blah, blah, blah went up 4%. I'm like, I don't understand it. And so like, I really like the Data Deli, Dave Meyer. I think it's the Data Deli, but it's something like that. I follow a lot of stuff that GoBundance puts out there. Like, so like, that's my favorite thing about GoBundance, just a lot of smart people talking about the economy, and we're always wrong. Everyone's wrong all the time. That's okay. Cause it's not about, what's the great quote from, I think Eisenhower once said, plans are worthless, but planning is everything. And so like you can say this is what's going to happen, and then you'll be wrong. But it's the act of saying this is what I think is going to happen, and then doing that every single day that helps. It's the planning and the
100%.
Right. So I'd get a lot of my stuff from the GoBundance fellas. And then there's just a lot more like just friends. I follow specifically on Instagram a lot of smart friends, and I choose to see their stuff. I even like turn on notifications for them. Yeah. Because they're smart and because they can give me a lot of like, that market data. I mean, well, I'll get one example would be AJ Osborne. He's a good buddy of mine, runs self-storage out of Boise, Idaho, has a huge portfolio. He's in GoBundance as well. I love watching him because like he understands things about the market a whole lot better than I ever understand things about the market. So yeah, it's been huge.
I love that. And I follow him too.
Yeah, nice.
All right. So here's what the meat and potatoes, man, that I want to get into. I told you on the front of the call, I'm in and connected with new construction, from ground up development, vertical construction, and we have opportunities that are before us right now. So as we look ahead, we look at the shifting market, we look at the days on market, the showings for our inventory that is for sale. It's all growing. And we have opportunities to trade some of our margins from the development side and the construction side to the hold side. And so with that being said, it's time for us to look at, well, how do we fund these developments? And how do we scale this kind of opportunity? How do we scale acquisitions, even if it's just land opportunities that we can get to put an affordable development on that land? And so with that being said, I want to go back to your years of starting Open Door Capital and how, from a team building standpoint, what you did versus the first hire, the second hire, so forth and so on. Really, I don't even know the right question to ask other than, if you want to start a fund, I want to start a fund. I have people with money. I have projects. Now I need to bring them together, and I'm only one person. So in terms of the fund and the team players, what would you say? Where do we start?
Yeah, good question. So I'll give you a little of like the answer within my story of how I did it and what I would do differently. I'll start by saying, for those listening, you might be like, oh, Open Door Capital. I've heard of Open Door. They buy all those houses. That's not me. So like I had the name Open Door Properties for years. And then the company Open Door started. They're a giant wholesaling company for single family houses. And then now I have Open Door Capital. We're actually going to change our name because of the confusion there. So
you know what's funny is that never crossed my mind. But I know about Open Door. Yeah, okay, that's good. Open Door, but it's just never crossed my mind. Like, obviously your branding has worked. Yeah, because when I think of Open Door, I think Open Door Capital, Brandon Turner.
That's funny.
It's crazy, but I like the disclosure.
I get people all the time that like, I literally get like people from like high school friends of mine who will send me messages on Facebook and be like, hey, I saw the sign pop up in my yard. You guys are selling this house. Can I just buy it directly from you? Do I have to go through the company? And I'm always like, that's not me. I don't do that. I don't do single family houses. Anyway, so if I get at least once a week, somebody makes that confusion, like point to me, that I'm like, all right, so now I think people think it. So anyway, name change is coming in the new year. But Let's see. So when I got started, I'll tell the reason why real quick. I was on stage at the Best Ever conference in Denver, which is a great conference for syndicators. And I'm sitting there teaching on stage all this fancy stuff about, like how I'm able to, grow my business and blah, blah, blah. And I'm looking out in the audience and I'm like, man, I don't deserve to be here. Like, I am the least qualified person in this room. There's 1,000 people out there who have more deals than me, way more experience, they're doing it full time. I'm on stage because I got a big mouth, I'm good at talking, and I have a good podcast. Like, that was the truth of it. And I was like, I left there going like, oh, like I want to deserve to be in this room. Like it was that time I was talking to Jason as well, Jason Dries about this. Like I want to go bigger, like not because I needed to for money reasons. Like I was happy enough, but because there's so much joy and excitement in the climb. And I'd already kind of conquered the climb when it came to the podcast and the book writing. I'd done pretty well. So anyway, that I left there going, I'm going to do something bigger. And I read the book Vivid Vision by Cameron Herold. And I got home and I was like, all right, I'm going to build this. And here's what I did differently than most people do. Now, when most people build a business, they start from the bottom up. And what I mean by that is they do everything themselves. And then eventually they hire the person right below them, like an assistant. And then they elevate themselves a little bit. And then they hire someone else below them, like a marketing person. And then they elevate themselves a little bit. And they just keep doing that process of elevating themselves in the company until eventually they're in charge. They're the CEO of the company. But that can take anywhere from, a year, 2 years, 5 years, 20 years to get there, 50 years. Like it took forever. So I was like, well, what if I just did opposite? What if I turn that upside down? And I just was like, what if I hired from the top down? So I brought in my buddy Ryan, and I landed that from that plane ride home from that conference. I wrote my vision after reading that book, Vivid Vision. And I had a very clear, I said, I wanted $50 million of real estate. I wanted to raise money from like 100 different investors. I was going to do blah, blah, blah. I had all spelled out. I was going to have 5 or 6 people working with me. I just kind of specced out my organizational chart, my org chart. And I landed and I brought it to Ryan. And I was like, Ryan, this is what I want to do. And he said, I want to be a part of that. I said, great, because you're running it. And like, I just let him run it. Like I let him solve all the hard questions of like, what kind of fund do we do? And what kind of, how do we figure out what to buy? Now, it wasn't perfect. I was involved a lot, but it was very much a different approach than anything else I'd ever done before, because I hired from the top down. And I don't know if I will ever build another business another way, because it was so much better than anything I'd ever done before. Because like all those little questions of like, do I need a 506C or 506B? They weren't even like, I didn't even have to deal with them, because I got somebody who's financially like, he's a partner. He owned a large part of the company, still does, to run it for me. And there's things that I did and I had to be involved and I was in the meetings, but I didn't have to go hunt down every answer. I didn't have to be the personal assistant or the marketing guy, because I just hired them all from day one. So I know it's a little different answer than what you're asking for.
No,
I'll get to the more specific, but
I love that, man. I mean, that's what I did with my team. It's kind of, you build a vision and then you backfill it.
Yes, you backfill it. Yeah. And you're just like that, like, if I had that team, like that's what I said. If I had a full-time investor relations person, if I had a full-time acquisitions person, if I had a full-time assistant, if I had a full-time COO running things, if I had a full-time like finance person, if I had those 5 or 6 people, could they buy $50 million of real estate? And the answer was no. They bought $300 million of real estate in that same period, right? So like sometimes when you assemble the right team, you don't hit your goal, you exceed your goal, you far exceed your goal, because the right people with the right systems and the right vision, that's where you get just monumental growth. Those 3 things, right? You have the vision, you have the people, and then you have a system to manage it somehow to make sure everyone's doing what they're supposed to be doing and they're all lined up together. And that really was the magic for us. So that said, so let me give you a few specifics on that. So the first thing we did, we're like, well, we need to figure out how to raise capital. I've never raised capital before. So I called up a couple of buddies who raised capital. I'm like, hey, like, what do you do? Right. And the answer was, oh, go talk to this guy. And it was like an attorney. Right. So we're like, oh, okay. So we go and talk to their attorney. And man, like there's one encouragement I can give you as you're looking into the fund thing, is it's so much easier than you'd ever imagine, because attorneys take care of everything for you. Like, it's really kind of shocking how much work they do, like for how little they make. I mean, they make 20 or 30 grand, but and maybe the hours aren't a lot of hours, but just the learning curve. Like the attorney's just like, okay, yeah, we're going to set it up this way. Here's the forms we're going to use. Here's what you can say and can't say. Here's how you're going to do it. And they just set us up and they're like, all right, go ahead and raise money now. And we were a 506C, and we chose 506C because I have a public presence. And with a 506c, it's a little bit of industry speak here, but for those wondering, like a 506c syndication means you can advertise, you can talk about it publicly. I can put it on my Instagram or my Facebook, but I can't raise money from people unless they're an accredited investor. So they're a rich person. Now, the alternative is usually a 506b. A 506b says you can advertise, but you can borrow money. You can raise money from your uncle who's not super rich. He's just got $50,000 in a Roth IRA. So I can't touch my uncle's money from a Roth IRA unless he's super rich. So that's just the trade-off. So it was working with the lawyer, and we did the 506c, and our goal was to raise $5 million in that first raise. And now I'm let me pat myself on the back a little bit here. Like, I'm Brandon Turner from the Bigger Pockets podcast, 100 million downloads at the time. I've sold millions of books. I'm like, oh, $5 million, that shouldn't be hard at all. Nope, couldn't do it. Had to shut down at $3 million.
Wow.
Right. So the first time people didn't trust me, and they shouldn't have. Like, those listening right now who gave me money in that first round, like, I love you, but like, what were you doing? Right. Like, I had no experience in syndication. Now, in reality, they were betting on my ability to figure it out and my ability, like, they were trusting me. And I love that people did, but it was hard. Now we raised 20, 30, $40 million in a day or two. And so the reason I tell that story is because, one, I want people to realize just because I had a big name didn't make it easier to raise money. In fact, I have two friends right now that tried to raise a lot of money this summer. Both have bigger audiences than me. They have more followers than me on almost every social platform. They have bigger audience. They have bigger views and everything. They couldn't raise $5 million either. At the same time, in that same period of time that they couldn't raise I think they got tapped out about $2 million. In that same period of time, I raised $122 million, even though they have a bigger audience. So what am I trying to say here? I'm saying that if you don't have a big audience, it doesn't actually, like, a big audience doesn't matter as much as you think it might. So if you're listening to this going, I want to start a fund, but I don't have a big audience. You don't need a big audience. What you need is reputation over time. That's what's given me the ability to raise capital today, is reputation over time. My brand as a trusted steward of other people's wealth has grown over time. And whether you have 2 people following you on Facebook or 2 million, either way, you have to establish that brand. That's the most important thing, is, are you a trustworthy person? And then, do you have their email addresses? Because the more people you can communicate with on a regular basis, the more they're going to like and trust you, and the more likely they're going to give you your money when you have a deal. So I'll stop rambling at this point, but yeah, that's some of the biggest lessons I learned there.
This is golden information. So you started with your friend Ryan.
Yeah.
And you paid him by being a partner. So you said, hey, if we can do the deal, then you get a percentage of the ownership, or percentage of the profits. Until then, no salary, no hourly, nothing. This is just, we're putting all our cards on the table. If it works, we'll do good. Okay. Who was the next person you hired? The attorney. You got the attorney.
Yeah, we hired an attorney in there. Actually, the story gets it's a little more nuanced than that, just slightly. That day I talked to Ryan, there was another gentleman there as well. There was actually 3 of us on the lanai, on the front porch. We call them lanais here in Hawaii. So there were 3 of us, and we're like, let's just split it third. You take a third, I'll take a third, you take a third. And I was like, yeah, it made perfect sense. So we went out there, and like, I was going to be in charge of the money raising. Essentially, I was the money raising aspect. Ryan was kind of like the operations piece, and then the other guy was going to be acquisitions. Well, a couple of weeks in, I just realized, like, the other guy wasn't going to work out. Not because he was a bad guy. I like him a lot. He's a good dude, but he had a multi-million-dollar a year wholesaling business, actually very similar to Open Door, that he was working on. And all his time and effort and mind was on that project. And so right away I was like, oh, shoot. Like, we can't scale if a third of my company is distracted at that level. So it took a few months. Like, he ended up being the first deal with us, but ended up by the second deal he was out. We ended up, and that was really painful to get rid of him, and then to lower Ryan's equity. I had to lower Ryan's equity down, not because I didn't like him, but because all of a sudden I realized I'm gonna have to have a lot more people and give a lot more equity, and I'm gonna have none left. Like, I was way overly generous with equity in the beginning. There's a something I learned from Josh Dorkin, founder of Bigger Pockets, years ago. He said, basically, the amount of equity you give to your team is a inverse relation to how successful you think you're going to be. In other words, if you give somebody 30% of your business, you probably think you're going to have $1 million business. If you knew you were going to have a $10 billion profit someday, would you give somebody 30%? Probably not. That's why tech companies give 0.25%, 0.1%, 0.00%, because they know they're going to have these massive things. So what did me giving a third to one guy and a third to the other tell you about my views and my confidence level there at the beginning?
Bro, that is, in GoBundance events, we have bonus time.
Yeah.
When you get what you came for, and then everything else is, that was my bonus time moment.
Oh, good, man. Josh Dorkin taught me that. It was
that is fantastic, because I'm a generous person. And I want my people to make it with us, right?
Yeah.
But that is just golden, because that is small thinking. If you got to give away so much of the percentage, right? I love that.
Yeah, which goes back to why I believe so strongly in having a mindset coach, because this is the kind of questions that Jason would drill me on, like why, how big do you think your business is going to be? Why would you give away that much equity? All those things. Also, I didn't realize this is the biggest lesson from that whole thing was that you never know how somebody is going to be until you actually work with them. Up front, I had no idea that Ryan was going to be a complete monster rock star, superhero, and that the other guy was going to be distracted. I mean, the other guy was a rock star monster superhero in his own business with single family houses. So I assumed he would be the same for the mobile home park space, which is what we started buying. And he just wasn't. You never know how people are going to be until you actually work with them. So that it creates this kind of chicken or the egg problem, right? Because I want to bring in good people, but how do you find the good people if do you hire them first and have to fire them if they suck? That's painful. So what we discovered, because you asked that question, I'm leading into that answer of who was the next person you hired. We had this brilliant idea. I thought at the time, it actually was a terrible idea, but brilliant idea. And I said, let's bring in 10 people to work the sales piece, going to find deals for us. So they're going to be cold calling owners of mobile home parks. They're going to be talking to brokers, but I'm going to bring in 10 acquisitions people, interns. They only make money. And I was they'll make 10% of the deal if they find the deal. Then I'm going to bring in 10 underwriters. They're going to run the numbers, analyze it perfectly. And then they're going to work together, and that the underwriter gets 10% of the deal. So in my mind, this was a really good idea. Ended up being terrible because all the people were stepping on each other's toes and calling the same broker. 4 different people would call the same broker, and they all work with Brandon Turner. It became super hard to manage. However, in that internship program, the first week, one of those interns in the acquisition side was your guys' underwriting model is terrible. Let me redo the whole thing for you. And he made he spent the next month rebuilding our entire underwriting model to something I've never seen before. So incredibly good. While he's also working a full-time job, while he's also doing this, the other acquisitions for us. He rebuilt the whole thing. He started organizing and teaching other people how to underwrite better within the group, the other interns. And I was like, this guy is a rock star. That guy ended up being our first hire. His name was Walker Meadows. So we ended up bringing him in full-time as director of acquisitions. That was the first actual salary position I ever paid. A year later, he was COO of Open Door Capital, and today he is still COO. He runs my entire operation. I mean, he is the most vital piece of everything. Ryan and I are now on the board of directors, along with Brian Murray, and Walker runs the entire thing. As an unpaid intern is how I found him. At the same time, remember the other intern group, the people that were in charge of that was the underwriting one. So then the acquisitions one, the other group, I think I said that wrong a minute ago. The other one, which was doing all the cold calling of the mobile home park owners. One of those guys was hey, we're all stepping on each other's toes. We're calling the same people. It's a hassle. He started organizing and helping the same way. That guy was my second hire. That was Mike Williams. Mike, we brought in to work to be VP of Investor Relations. Still doing it today. Unpaid intern. Because the truth I'm trying to get to here is contrast that with the other guy that I gave a third of my company to just right off the bat. I had no idea. He seemed great on paper. It didn't work out. These other two guys, they earned their spot. So today we utilize that technique all the time. We always have internships going on. We always have fun. We always try to find ways to work with people, whether it's a JV, a partnership, an internship, whatever. We want to work with people to see how we like working with them and how we jive before we ever hire people. Because it's a whole lot easier to do that than it is to fire people later on. So that's been gold for us in the last few years.
I love it, man. That's awesome information. When you hired those guys, and actually brought them on, did you already have properties in the fund that would pay for those salaries? Or
Yeah, sort
you
of.
started funding them from your own personal pocket just to sort of start up the fund?
Yeah, sort of. So the first deal we closed on, we bought, that we raised that $3 million. That one had no salaries during that period. We had the internship thing going. We had the partnership thing going. We had a few things going. And then when we bought the property, I think we bought, call it $7 million worth of real estate. We got a 2% acquisition fee on that. So we would have got, what is that, 140 grand? Am I doing that math right? Or is it 14 grand? Yeah, 140 grand.
140.
Yeah, 140 grand, right? So we got about 140 grand in acquisition fees. Now, about a lot of that went to the partners because they were GP partners. So I only got probably half of that when it came down to it. So I had about 70 grand of capital then. So that's what we used to then fund the first couple months of the project. And it was basically, okay, well, we have 3 months of runway now, so we can hire 3 people for 3 months. We better close some more deals in there. And then we did. And then that got us 6 months of runway and then 8 months of runway. And today we have about 1.5 years of runway just sitting like cash, because I want to make sure I've got enough money to pay salaries for a long time if we can't find a deal. And so yes and no. So yes, I didn't use my own money, but I did use, I don't take acquisition fees. It's from day one. Brandon Turner doesn't take acquisition fees myself. Our company gets them, and I use that to pay salaries, and anything left gets dumped into the war chest to survive longer should we have a dry spell for a long time. So I'm still living off book royalties and the occasional other random way of making money, but I don't make money off open door capital until the end. And my investors, it's partially sales pitch, right? That's marketing.
I love it. Yeah.
It's also true. Like when my investors know that Brandon doesn't make money unless this works, you can guarantee you that I'm going to do everything in my power to make sure this works because I got a lot of money on the line.
So I heard acquisitions, I heard underwriter.
Yep.
Then I have Ryan and Brandon, investor relations. Who else am I missing? What roles on the front side? Really, what you're saying is on the front side, you had 3 people.
Yeah, pretty much. There's one more.
Say it again.
There was actually 2 more that I'll throw in that I think was helpful in the beginning. I had a guy. So I was having a conversation with Ryan one day, and we were just having a really hard talk about how bad the money was, in terms of organizing it. The money that we were raising all this capital, and it was in this bank account. I couldn't find the checkbook for it, and I didn't record the right thing, and I didn't have the right card. It was this mess of money, right? And I was I just need a finance manager to help with this. And we were also doing some flips at the time. Just here on Maui, I was doing a little flipping houses, and I go to my mailbox, and there's a letter in there from somebody who lives on Maui that found my address and sent me a letter with a gift card to my favorite restaurant. And he said, hey, I'm Micah. I'm a finance manager at a local hotel. If you ever need help with finance stuff, let me know. And I was like divine providence that day.
Wow.
I was I said it, and 5 minutes later, I'm opening this letter, and I was like, all right, you're hired. It wasn't that way. I actually made him intern for 3 months. He interned for free, handling the books of my flipping business and kind of advising on the fun stuff. And then once we realized he was a rock star, we brought him in full time. So having the finance person was huge because you have acquisitions, you have investor relations, and you have finance. As long as I have those 3 things, plus I had the COO, I had Ryan running it at the beginning, and then now Walker. And then the last piece was I needed an executive assistant. So I had an assistant for myself, just so somebody would manage my calendar. And, I was still doing full-time Bigger Pockets at the time. So I needed a lot of other stuff that wasn't the fund. And so
we're adding the underwriter in there. So acquisitions, underwriter, finance,
acquisitions,
investor relations, COO, and EA.
Acquisitions and underwriter were really the same in the beginning. Today they're different. But in the beginning, there was one person doing both those roles. It was just Walker. So, yeah.
So I want to close that loop on acquisitions. Brandon, are you buying data? How are you finding deals now? Or how would you recommend finding deals now, especially in light of what season we're getting ready to enter? Am I buying data, getting a VA to scrub it, and then sending out direct to seller letters? Am I advertising? Tell me what your thoughts are around that.
Yeah. So we tried all that in the beginning. We tried direct mail, we were cold calling, we were buying data and all that. It never worked for us ever once. Well, I shouldn't say that. In the very, very beginning, maybe it worked a little bit. We got a couple things that we were looking at, but the problem is we realized we don't like those properties that we were getting through that. And what I mean by that is they were too small. So for us, we learned very quickly that there is a massive benefit to buying big properties over little ones. I could buy a 50-unit mobile home park, which I did. It was just hell. But I can buy a 200 unit and it was still hell, but it was 4 times bigger. And you only had to raise money. So the only constraint was the capital we could raise. And once I learned how to raise capital better, we just started scaling up quickly. Ever since we started scaling up quickly, none of the off-market stuff has really worked. Simply because we're buying properties that are 10, 20, 50, $90 million. Like a beg letter to, with a picture of my family just doesn't really seem to work as well. Now, maybe it would, but they're all owned by just big like hedge funds and stuff. So everything we're buying today is all going through brokers. However, it's not like they're blasting it out to their list and there's a lot of people looking at it and we're bidding with 50 other people on these deals. Well, we just became quickly known as somebody who can close and will always close. And we have a reputation for that. And so now almost every single deal is an off market from a broker. In other words, it's a pocket listing, almost everything. So the brokers are coming to us going, hey, like, we know you can close. We're not shopping this to anybody else until next week. You get first dibs. If you want to take it. And so everything we get today is that way. If you're listening to this though, and you want to do smaller deals, yeah, all that stuff works. The cold calling, the reaching, the letters, all that stuff, it all works. It just, the bigger you go, the harder it is to capitalize on that because you're just not dealing with emotion anymore. You're dealing with really smart people that know what their property is worth. They're not making emotional judgment calls on the phone.
Sure. All right, let's transition to some numbers. I was at the GoBundance event in Steamboat, I think is where it was, where you shared your portfolio with us. And I remember you had discussed your cash on cash desire, like your target cash on cash return and your IRR. Where are you at right now? What are you looking for you to buy a property? Cash on cash, IRR.
Yeah, that's changing a little bit. So what we shoot for, I'll say, everything before this has been generally the same. And I'll say what that is first, and then I'll tell you why it's totally different going forward. I've always tried to shoot for 8% annual cash flow, like cash on cash return of 8%. I like to see that. And that's average. The first couple of years are usually a little less because we're always buying value add stuff, whether it's an apartment or a mobile home park, we're buying value add. My rule is I won't buy anything that doesn't cash flow day one, but it doesn't have to cash flow much day one. I don't want to lose money, but if it breaks even or slightly better, I'm okay with that as long as I have a very clear path towards an average cash on cash return of 8%. That's just a number that I try to shoot for. The second thing, IRR, is we generally underwrite for backwards from a 15% IRR. Now, we don't advertise that. We actually use AAR more often because it's a little bit higher number and people can grasp it a little better, like average annual return. But basically, if you want, like we take 15% IRR over a 7-year period and we just work backwards to find the number we can offer for a property. And most syndicators are doing something very similar. Yep. So if I can hit 15%, that makes me pretty happy. Going forward, though, we are changing that up quite a bit. We decided to start. We're going to actually test it out here in a couple of weeks. We're launching our first example of it. But we're launching what's called we're going to call it the Generational Wealth Fund. And the idea is we're going to buy properties and then never sell. Or when we sell, we 1031 as a group into the next one. So the idea is once you invest in, we're going to buy it. We're going to rehab the property, like these large apartments or mobile home parks. We're going to then, increase the rent, do all that work. We're going to then refinance them, get everybody their capital back. The goal is to get everybody all of their capital back within 5 years. And then we just hold on to it. We repeat the process. And then it's basically a giant burr. Like we talk about the burr strategy in real estate all the time. It's just a giant burr where our investors will stay in it forever. The more we talked about this, the more people are like, every single person was like, oh yeah, that's exactly what I want. Like I get my money back and I stay in the deal forever. And I'm like, well, yeah, but originally I fought the idea. I had a buddy telling me about this, Ken McElroy, actually, the guy who wrote ABCs of Real Estate Investing. This is what he does. And I'm like, yeah, but your IRR would be way worse. If you hold it forever, your IRR is worth. He's like, Brandon, no one cares about IRR. They care about financial freedom. They care about simplicity. They care about not having to re-put their money to work. And he said, if you want to maximize IRR, go flip houses. That's how you maximize IRR. Get people like 50% IRR because you sell it in 3 weeks. That's not the game we're in. I was like,
so this is why conversations matter, because forever since joining GoBundance in 2018, I'm like, I don't understand why they care about IRR. And because everybody else cared, I felt like I was dumb.
Same.
Like I should care about that because they care about it. I don't understand. And then I heard you say this sometime recently. And I'm like, yes, that's what why would we ever get rid of it?
Yeah.
I love it.
Yeah, that's funny. Yeah, so we're gonna change that from now on. So at least we're gonna try it, and I think we're gonna see a lot of.
Are y'all still targeting value add properties? Is that still your MO?
It still is, and that's more because a couple of reasons. One, like the good stuff's is getting eaten up at cap rates that are just unreasonable to buy. Like you can't. It's really hard to even get any cash flow for years if you're buying like really nice stuff. It's not impossible, it's just really hard, especially at the bigger, like the higher amount that we're at, because you're just competing with hedge funds. So in order to get deals, period, we have to do value add. We have to do the stuff that other people are not willing to do. When it comes to mobile home parks, that specifically means we buy properties that are more vacant than the hedge funds want to buy in.
Sure.
So we'll buy them when they're 30% empty, 40% empty. I'm okay with that because it's really, 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 really hard to fill up a mobile home park. It's incredibly difficult. So, pick your heart. Like that's where money's made. So we got really good at filling up mobile home parks because nobody else likes to do it.
Yep.
So we're still doing that, the value add stuff.
And on cash, where are you going to from 8% to where?
Yeah, I still kind of say I shoot for that, but here's where it gets difficult. So we're going to do basically there's a question between do you get a return on investment or return on capital or return of capital? So what we're going to do, it's a slight difference, but so let's say you were to invest $100,000 in my fund 7, which is launching here in a few weeks. All the cash flow you get is a return of capital. It's paying you back your principal from day one. So you don't pay taxes on it because it's your principal. You're getting paid back your principal. And then when we refinance the property, you're getting repaid back your principal. So all of the money that comes in is going to pay you back your principal as soon as possible. So what does that mean? It means that you're getting 0% cash on cash return until you get all your money because you're not making profit, right? Then when the deal refinances and you get your money back, now you're making an infinite cash on cash return. So you're making 0 and then infinite. So I honestly don't know how to even think about the math behind what that actually looks like. I suppose if I run the numbers over a long period of time, I'm sure I can extrapolate out what a cash on cash return is. But the way I look at it is like you're getting 0, then you're getting infinite. And if you want to average those out, it just kind of depends.
And so mathematically, that should help you underwrite deals a little better.
I think it should. I think we'll be able to pay more for properties slightly than we were before because it just doesn't matter quite as much.
Yeah.
But what we're going to aim for is like the speed at which we can refi because we're just a velocity of money game at that point. Just get refi as fast as possible, take the money, reinvest it into bigger deals. And so everyone's just wealth is growing. And here's the cool thing and why I call it the generational wealth fund. It's because like this money just goes and goes and goes for you, for your kids. And it's almost what we almost called it was like an accelerated cash flow fund because the idea is if we can get we're getting fixed rate debt on this stuff. If we can all possible, we're gonna get fixed rate debt. So what happens when you have fixed rate debt over the course of 50 years and inflation, just natural appreciation happens? It means that every year your cash flow is better than the year previous. That's the idea. Right. So every year you get more and more and more and more and more cash flow because your debt's the same. Now, maybe at some point we refinance again, get a whole bunch more capital pulled out because we can get a really cheap debt. But then you're going to dump that into something else that has accelerated cash flow. So in other words, everyone's just cash flow is getting better and better and better. So it's really like a financial freedom fund, a forever financial freedom fund, the 4 Fs. I don't know.
So
There's
good.
lots of possible names there. But yeah, I'm excited about it because I'm like, this is what I want. I just want cash flow. And I want my money back so I can get more cash flow with that money. I want to recycle that cash flow.
That's right.
So everything's changing right now, and we'll see how investors react to it here in the coming weeks. But I think they're going to like it.
I agree. 1% rule. I know that we kind of threw that out the window over the last year. Are we going back to that? Are we stuck there from where we were last year? It's the 1% rule doesn't work.
Yeah. I've never loved talking the 1% rule. I mean, I know it's a bigger pockets thing. They talk a lot about 1% and 2%. I mean, back in the day, we were all 2% rules, right? Like a lot of that stuff, like I'm just like, I just don't like it because there's too many variables that don't fit in there. So I'm very much an underwrite all the way kind of guy.
Got it.
When it comes to that.
Yep. All right, man. Kind of wrapping up. I have a property that I'm buying. It is with me and a partner at the end of this month in just 5 or 6 days, next Monday. So it'll be the biggest deal that we've ever bought. It's 48 units, and we're going to do a value add of 24 additional. So we'll have 72 doors at one property. And this is my gift to you for sharing your time with me. The seller will exit with about $2.5 million of his money, and he needs somewhere to park it. and he wants it to be passive, and he wants to get some depreciation if possible to mitigate his tax liability this year.
Yeah.
Do you have a need for that?
I do. I'll tell you what would be perfect for him. Like, so mobile home parks are the best depreciation asset in the world. Like if you go buy almost any asset, like real estate asset, like apartments are like 30 to 40% of whatever you put into a syndication. Like if we put 100 grand, you might get 30 or 40 in a loss the first year from depreciation, from accelerated depreciation. Self-storage is, I've heard, like 50%. Depends on what it is. Mobile home parks is up to 80 to 100% of the first year. So if you put in 100 grand, you might get $100,000 loss like year one as a LP in somebody's syndication. It's stupid good. So if I were that guy, I would dump all 2.5 million in my fund 7, because it's going to be a generational wealth fund. We're going to do the accelerated depreciation. It cash flows, and it's just everything we just talked about. The downside is it's only going to be a $20 million fund. So it's going to fill up. Like, we're joking about doing 20 million in 20 minutes. Like, and I don't think it's going to be much worse than that.
That's wild. So how do we get him in? How do I get him connected to you?
odcfund.com. If he's on our email list, he's going to get notified.
This guy may not even have email.
I just shoot him.
I got to facilitate
connect him with me personally, and then I'll introduce him personally to Mike Williams, my investor relations guy. And Mike will handhold that guy. We will even, if he's going to 1031 it, we'll even do 1031.
1031 in it.
Okay. He could 1031 it with us, but yeah, he wouldn't have to. You could also just accelerated depreciation. It's basically what they call it, a lazy 1031.
Yeah.
Like, you get the same benefit, but
yeah,
we could definitely help the guy. And because, man, the mobile home park stuff, that's why people, when we launch a mobile home park fund, every time it sells out within a day or two, because the depreciation, the tax benefit is so good on the mobile home park stuff.
Now, you're buying mobile home parks without the trailers, right? No park-owned homes.
Yeah, correct. And that's why they're so good. Yeah, that's why they're so good. So we're buying them in areas with cheap land, right? So we're not buying land because the land's really cheap in like areas like Ohio, the Midwest, whatever, right? We're not buying the homes. So what are we buying?
The infrastructure.
The infrastructure. Now, in reality, let's talk specific. In reality, we're buying a business is what it actually is. But from the IRS standpoint, the value isn't in the land. It's not in the homes. It must be in the infrastructure, because they don't have a mechanism for thinking about real estate as a business. And so they give like a mass amount of the value is in the infrastructure. It's in the pipes that are in the ground. It's in the street lights. It's in the roads, and all that gets depreciated out over a shorter period of time, which is why mobile home parks do so good.
Man, that's fantastic. Brandon, if somebody wants to get in touch with Open Door, is that the website that you want them to go to?
Yeah. ODC Fund. Yeah. odcfund.com. And that's it. You can also shoot me a message, Brandon at odcfund.com, or Beardy Brandon over on Instagram. I check all my DMs and emails and all that.
Man. Dude, this was awesome. I've got all the content that I expected to get. If I can do anything for you in South Louisiana, you got my contact information. I'm connected with your assistant. And by the way, Matt or Mike?
Yeah, Matt.
Matt, yes.
Well, I have a Mike too, but Matt. Yeah.
Okay. Yeah. I wrote both those names down. I want to do a podcast with him. And that's what I was telling him. What's it like to be Brandon Turner's assistant, and how has your proximity to him changed your world? And we got to connect about that when we were setting up this appointment, and he was fired up about it. And I would love to share that with other people.
Yeah, he's a great dude. He is phenomenal. In fact, I just promoted him. It's the saddest day of my life, but I got a new assistant helping. But I just promoted him director of marketing. And so he's still doing all my assistant stuff because we're still transitioning to the new assistant. But he was the best assistant I ever had by 100. Like, that would be an interview interview him on how were you so good? Like, why was he so good? And that's the thing with all the good assistants. Everybody I've ever known who's been like successful for years in business has said the same thing. The best assistant you can't keep as an assistant. You have to elevate them, because you find other spots in your business that you need them more because they're that good.
So good. I love it. I can't wait for the conversation. All right, man. Thank you so much.
Thank you, man. Appreciate you. You're awesome.
We'll see you around.